one of the 5 stocks we're covering today, has consecutively increased its dividend payout for over 60 straight years. Another is pioneering the move into the world of digital currencies, a move that stands to benefit if the Fed continues to cut rates. And a third owns a massive stake in OpenAI, with analysts projecting a bullish 30% growth in the coming year. As we approach 2026, we're entering a period where the Federal Reserve is expected to continue decreasing rates. Historically, this is a massive tailwind for value stocks, which means when borrowing costs drop, these stable and mature companies will thrive. When you buy a stock, you aren't just buying a ticker symbol, you're buying the future. Today, I'll be sharing 5 essential stocks across different industries to build a balanced portfolio. We'll look at their fundamentals, their technicals, and most importantly, whether each one is going to be flagged as a buy or pass using a data-backed stock score system. Before we dive in, just a quick note, investing involves risk, so please make sure to always do your own research. This is not financial advice, this is purely educational. Now, if you're ready to watch the breakdown, do me a huge favor. Hit that like button right now to support the channel, and let's start with a classic. Our first company is Warren Buffett's favorites, and for a good reason. Coca-Cola is the definition of a value stock, a mature, global giant with a dominant market share and a dividend that has increased consecutively for over 60 years. Most people see Coke as just a soda company, but it's more than just that. It's a massive global distribution and marketing machine, owning everything from Costa Coffee to Fairlife Milk and Powerade. In terms of growth potential, they are well positioned because lower interest rates typically weaken the US dollar. Since Coca-Cola generates the majority of its revenue internationally, a weaker dollar makes their overseas earnings much more valuable when converted back. As we move into 2026, their ability to pass on price increases to consumers while maintaining massive cash flows makes them the perfect defensive anchor for any portfolio. TradingKey gives Coca-Cola a solid stock score of 7.6 out of 10 based on its earnings and financial health. And according to CNN Business, it's bullishly forecasted for a 14.2% increase for 2026. To me, Coke's legendary long-term stability is a clear buy signal. Now, before we move on to the next stock, I'd like to point out that I'm going to list out a comparison of all 5 stocks at the end, so just make sure to hang around for that. If Coca-Cola is what people buy, Visa is how they pay for it. Our second company, Visa, operates in a near duopoly, providing the invisible infrastructure for the global economy. Visa doesn't actually lend money. They just take a small fee every time a card is swiped or a digital payment is made. This means they have almost no credit risk, but all of the upside from global spending. In terms of growth potential, they are well positioned because of their massive pivot into stablecoins and blockchain integration. By 2026, the integration of digital currencies into traditional payment rails will be a major revenue driver. Furthermore, as the Fed cuts rates and consumer credit becomes more accessible, transaction volumes naturally rise. Visa currently holds a stock score of 8.6 out of 10. Analysts from CNN Business are also overwhelmingly bullish, seeing a potential upside of 16.8% in the next year. What does that mean for you? Visa is showing a very healthy entry signal right now. If you're looking for a high-margin business that's actively future-proofing its moat, Visa is a strong candidate to start a position in before the 2026 spending surge. Next, we're looking at a sector that benefits directly from rate cuts. Automotive. General Motors, better known for its ticker GM, is a legacy giant that has been trading at a value discount for years. But the internal transformation is real. GM is currently navigating the difficult transition from internal combustion engines to electric vehicles, all while maintaining their high-margin truck and SUV business. In terms of growth potential, they are well positioned because car demand is highly sensitive to interest rates. As rates drop through 2026, financing a new vehicle becomes cheaper for the average consumer, driving up sales volumes. Additionally, their OTM battery platform is reaching scale, which should lead to significant margin expansion as their EV production finally becomes profitable. GM's stock score sits at a solid 8.2 out of 10. However, it's worth noting that analysts from CNN Business have forecasted its median growth in 2026 for a conservating 3.2%, and this is likely due to the volatility inherent in the EV transition. This means that if you're looking for a single entry point, you might want to wait for a dip. But if you believe in the long-term pivot to EVs and the power of lower rates, dollar cost averaging here allows you to capture that significant upside over time. By the way, make sure to hang around for that final comparison table to see how GM's upside compares to the others. Eli Lilly is a mature healthcare company, and it has recently come into the spotlight, specifically for their GLP-1 medications like Ozempic, Zepbound, and Mounjaro. As a leader in the pharmaceutical space, they are well positioned for growth because the demand for weight loss and metabolic health treatments is a multi-decade trend. By 2026, production constraints will likely be resolved, allowing Eli Lilly to capture a massive share of the global Ozempic class market. In a world where healthcare spending is non-negotiable, Lilly offers a stable sector safety net with the explosive upside of a biotech breakthrough. Eli Lilly has a stock score of 8 out of 10. Analysts from CNN Business have forecasted LLY for a 8.6% upside for the next year. So, if you're equally as confident as I am, you wouldn't want to miss the next leg up in the healthcare revolution. Just one more stock to go before we hit the full comparison. Finally, we have Microsoft. While many see this as a growth stock, its maturity and diverse revenue streams make it a premier value play for the long term. Unlike Apple, which is heavily reliant on hardware cycles, Microsoft's services span across cloud with Azure, gaming with Xbox, and enterprise software like Teams, Excel, and Docs. In terms of growth potential, you might not know this, but they own a significant stake in OpenAI. By 2026, the hype of AI will have shifted into actual bottom-line results. Microsoft is integrating AI into the Office suite used by every major corporation in the world. This creates a sticky ecosystem that businesses simply cannot leave. As for their stock score, Microsoft is standing at a strong 8.5 out of 10, the highest of our list. They are also forecasted for a bullish growth of 29.8% upside in 2026 based on the analysts from CNN Business. This is a strong buy with a rare green light across both fundamentals and technicals, which means that whether you're timing for a single entry or intend to DCA your way through, Microsoft would be one of the most compelling value plus growth plays for 2026. And there you have it. 5 stocks represent a balanced approach for 2026. As usual, let's look at how these stack up on TradingKey's stock score system, evaluating the current entry point based on momentum and valuation percentiles. Also, feel free to check out the link in the description to try it out yourself. The data-driven directional signals here suggest that while the hype might be in other sectors, the long-term value is in these established moats. If you want to protect your portfolio from volatility and buy the future while others are chasing the past, these are the names to research. And that wraps up today's 5 value stocks to watch in 2026. Let me know in the comments which one is your favorite. If you have stocks that you'd like me to research, let me know in the comments down below. And as always, thank you so much for watching. Be sure to subscribe for more analysis, and I'll see you in the next one.